Some breaking news crossing the wire here. Taking a look at the consumer price index coming in just a touch below expectations for the month of April here, coming in month over month at 0.2%, slightly below the survey number of 0.3%. Year over year also coming in just a touch soft, coming in at 2.3% versus the survey data expectation of 2.4%. Interesting to note here that year over year increase is the smallest since February of 2021. Taking a look at some of what's moving this under the hood, the index for shelter rising 0.3% in April, accounting for more than half of the all items monthly increase here. Taking a look at CPI ex food and energy year over year, coming in bang in line at 2.8%. That aligns with the survey number of 2.8% as well. Interesting to see some of the decliners across the board here. Taking a look at eggs really falling off, deflation there of around 12%. Overall, this print coming in slightly better than expected, particularly of note given the fact that this is coming in off the back of those tariff negotiations. A question as to whether or not those negotiations are going to impact the data like this going forward here. That super core number month over month here again coming in at 0.2%, year over year coming in at 2.743%, just a tick below the prior of 2.864%. Taking a look at the market action here, it does appear like we're not having too big of a reaction at the moment, but we're going to continue to monitor all of those moves for you going forward throughout your day. Again, that inflation data coming in just a touch better than anticipated.
Just want to get your initial read here on the CPI report this morning.
Yeah, it came in a little bit soft, so 24 basis points month on month. We were looking for 0.27, so really not that different. I think the key thing for everybody to keep in mind is the tariff impact hasn't really played out yet. So that should happen in the next couple of months. That said, the good news is, of course, the tariffs are a lot lower than we initially anticipated. So as of now, you are still seeing some weakness in services, so that's something to keep an eye on. It does suggest that, certainly on the travel side, the consumer is a little bit softer here. And then the good side, it was a little bit mixed, but overall the net was a little bit soft. We should expect that to change in the next couple of months. I think the key thing that the report brought to light is that the consumer on the travel side is certainly a little bit weak.
Let's go into that then. Where was there evidence, if any, of the trade war's impact coming up already in this CPI print?
Toys were a little bit firm at 0.3. Some of the other goods prices that come from China were a little bit firm, but it really wasn't all that strong. The thing to keep in mind is that retailers have inventory of several weeks, often up to about 2 months. So the real tariff impact from April 2nd totally has not made its way onto shelves. So that's when we anticipate it to actually feed into consumer prices. As of now, they're selling pre-tariff inventory, which shouldn't have an effect from a price perspective.
And so all those things considered, how much of the kind of tariff effect do we expect to make its way through, as we know that there have been some of the measures that companies have been taking, saying they're not going to take on that tariff cost, and they're having some of the inventory just sit out, not port, until they know that some of the rates have decreased. And we've started to see at least the pauses temporarily for 60 to 90 days at this juncture, and what that could essentially mean for the flow through to prices from your best estimation.
The main conclusion from lowering the tariff rates to a more sustainable level is that companies will try to pass through most of the costs. Because now we don't have a consumer that's likely facing the potential recession. The economy should be okay this year, which means companies are going to try to pass through as much as they can because they don't want to take the margin hit. And to the extent that the consumer is holding up, they might be able to actually eat a lot of that cost. So that's certainly good news for company margins, which is one reason why the equity market's reacting so positively.
So where does that leave the Fed then, if we will see more of that pass-through and cost lead to higher inflation going forward?
Yeah, I mean, the market's pricing in 2 cuts for the Fed. We still officially have that in our forecast. The risk is certainly that there is fewer cuts. If we're sitting here in Q3 or Q4 of this year, and the economy's holding up quite well and inflation is elevated, there's not a great reason for them to be cutting. They're probably going to want to just wait it out. They were only going to be cutting if we saw a substantial rise in the unemployment rate, which, if the tariff impact isn't that large, there's not a great reason for companies to be doing big layoffs.
And so with that in mind, as you're thinking through the company-specific movements that they're making, but then additionally on the Fed side, just to continue that frame of mind as well here, what and how long of a trend would they be looking for in the data points that they're monitoring on the inflationary side and on the other side of the mandate, on the employment side?
Yeah, so they're expecting it could take a couple of months for it to really pass through. So I would say if it lasts for more than 3 to 4 months, I think that we have to start wondering to what extent this is going to be a little bit more persistent. I think that's probably going to be the case. We're likely to see more persistent inflation, partially because there's going to be second-order effects. So if you think back to what happened after COVID, not only did used vehicle prices go up, but then motor vehicle insurance picked up later. So there might be other parts of the data that might have an effect that we're not necessarily anticipating, and that may take longer to actually pass through into the CPI prints.
It makes me wonder, too, how you're thinking about something that has been a trend for a while, which is shelter's contribution to CPI. It was obviously one of the major contributors to this one, even though it was the smallest increase in inflation since February of 2021 on a yearly basis here. But housing is such a sticky part of inflation. So how do we get to the Fed's 2% goal with shelter prices still high?
Yeah, and we're not going to get to the Fed's 2% goal in the near term. We're likely to be sitting with inflation closer to 3%. The expectation was that shelter should come down, and we still expect that should be the case, largely because what's happening real time in market, in the rental market, is that prices have slowed down quite a bit. That hasn't been reflected in CPI. So there still is this lagged effect where OER and rent should come down. The thing is, the tariff impact should more than offset that. So we're unlikely to be talking about 2% inflation this year. That's just not the reality. So we're not going to be at the Fed's target. The only reason they would be cutting interest rates is because the economy is softening, certainly not because inflation is missing their forecasts.